Ladies and gentlemen of the crypto space, we're live at 11:28 a.m. on Wednesday, February 17th. Deep breath. Breathe, everybody. The amount of data and what's going on is paramount and extraordinary. I often start these streams and I don't necessarily know where to begin. A lot of it's shoot from the hip. And truthfully, I think of the title of a stream 5 minutes before the stream. It's basically what's going on, and the stuff that's going on is a crossroads. We're at a turning point. The macro data is breathtaking, stark. And you look at the news headlines. I like CNBC, and I follow other news headlines as well. And and the only way I see them is short sighted. I don't think there's many macro folks that understand the big picture, at least from what I hear in the commentators and the guests. Um, there's no real big strokes and serious in depth um, dialogue that I encounter. Um, Literally, that's probably why Real Vision is so exciting and interesting and useful and meaningful. And those are where that is the place where you are exposed to persons that have the mindsets that are digesting the scale and scope of what's going on. Obviously I invoke those names and my favorite names that I've encountered and discovered on that platform more often than not. You guys know the names that I talk about, and they have significantly influenced my capacity to understand these systems from a macro perspective. And what's most interesting is my ideas are my own. I can agree or disagree with many of them, and I appreciate countless contrarian ideas. But really, are they contrarian? You got Stephen Van Meter, Jeff Schneider, and Brent Johnson. I don't even think they're contrarian ideas. They're contrarian maybe relative to mainstream, but I'm about to start a show telling you guys the dollar looks ridiculously bullish. Bear in mind, everyone on Wall Street expects the Fed to print, 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 and cause inflation. So the data is contrary to actually what people think is going on. And that's probably where we'll start the show. Incredibly bullish dollar in the paper tower. The paper tower. Today's episode is sponsored by Change Angel, the non custodial swap exchange for social good. Stop depositing on exchanges, not your keys, not your crypto, non custodial, DeFi, or nothing at all. Bam! Let's pop it over to the main screen and see what's going on. Christopher's in the house. Crypto Chick, yes. Igor, RR, Mark McNeil, Digibyte in the house. What's this Cosmos upgrade all about? Cosmos is a massive, 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 massive deal. The Cosmos upgrade is their Stargate, which is basically what was it? The IBC. Basically their inter-Cosmos hub communication protocol. So Cosmos, just like Polkadot, is a blockchain of blockchains facilitating interoperability between the deployed blockchains. Um, that is massive. So what fascinates me most about Cosmos and Polkadot is their ecosystems of blockchains. So to put things into perspective, you don't need much more than to be part of one of those ecosystems to be an extraordinary force in the crypto space. You don't need to be your own independent blockchain, and very few L1s will catch network effect. Sure, you'll have smaller players. There's always smaller players. There's always the lift. LYFT compared to Uber, there's always the lift. But come on, man, you got Ethereum, which has all the network effect. I mean, straight up all the network effect going on right now. You got Polkadot and Cosmos, which are absolutely on fire. In my opinion, the next runner up is Elrond. Um, they have serious momentum. Um, Arguably, everything else, I just is off my radar entirely. I don't think they could catch up. It doesn't work like that. There's no such thing as catching up. It took 20 years for Apple to become what it is compared to Microsoft, and Apple has not, never has, and likely never will disrupt Microsoft's primary business, which is corporate software. It's not going to happen. If it would have happened, it would have happened already, and to such a degree that Apple doesn't even try. Um, and Microsoft is thriving, and they are an industry titan, and they will not be disrupted. Um, the market leaders carry the network effect, and this is just time and time again throughout history the way it works. Now, clearly, over 100 years, many things change. You have entire industrial transformations. ExxonMobil was at one point one of the biggest um, companies on the planet. Standard Oil got broken down, and you had government intervention, and now you have the energy transformation that's occurring, and they're gone. They're done. Oil and gas done. They're just smart money is not applying value to oil and gas. Smart money is already in the tech that is going to appreciate for the next 10 years. And this is where I talk about, battery metal miners, which are just good. Man, you guys got to see this. You guys got to see this stuff. I want to talk about bonds, short end of the curve, long end of the curve. I want to talk about the dollar and the NASDAQ breakout. But AMY, you guys got to see this chart. I mean, let's go to the weekly. I mean, look at this. Weeks, years. Think of this, years. I was in here somewhere. I have to zoom out. I was in here down here, and this is fascinating. They've been around a long time, but 17. This was hot. This was hot. 2017 for a lot of these companies was fire, and yeah, you guys see what's going on here. What's so fascinating about this is the broad equity space is a paper tower. The inflated state of the broad equities market is not fragile. It's beyond fragile. It's ready to crumble. It's on a precipice. These assets have no business being at these valuations, and they're propped up by persons that are applying value that have absolutely no capacity to withstand a depreciative cycle. When Tesla drops 30%, it's not going to just drop 30%. That thing's going to crumble. Now, bear in mind, then it's a great buy. It's an absolutely ridiculous buy, and that's Warren Buffett style. That's his investment methodology. He sees that he doesn't know when the markets will crumble. Obviously, they call it the Buffett indicator. The market cap, what, 200, 200 times market cap to GDP or whatever the heck it is, 200%, not 200 times. But he waits for the market to crumble, carries his value in cash, and literally buys companies. He just gobbles up. That's his shtick. Shtick. A Yiddish terminology. That's what he does. And it's all good. He's obviously incredible at it. But there's countless ways to capitalize on the system, not just the way he does it. You don't have to do what Warren Buffett does, and I personally don't subscribe to that methodology. I understand it. I could deploy it. I don't have much interest in it. I think there's extraordinary opportunities, and the fact that I'm technologically inclined, whereas Warren Buffett is not technologically inclined. He doesn't understand these systems. He might not even understand macro the way I do. He doesn't see the things I see. And it's going to be very interesting the way things play out over the next 10 years, because I think some of the best opportunity in the last 100 years exist right now in the stock markets. Look at this stock. So this stock, along with countless others, are good examples of where the market's heading. This is an uninflated asset. This asset has basically zero inflation compared to the broad equity space, 200% market cap to GDP. That's absolutely insane. So Value transfers from inflated assets to uninflated assets because inflated assets only have so much more upside. And the fact that the inflated assets are supported by retail investors that have no capacity to withstand even a moderate depreciative cycle, they will crumble, which will liquidate a historic amount of value into dollars and bonds, because those are the quickest ways for value, quickest destinations for value to be liquidated into. So when the stock market crashes, the broad stock market crash, I don't give a crap about what crashes. I care about where that value is going to go, where trillions and trillions of dollars of value is going to go. Let me check the stream real quick. Let me make sure I said hi to everyone. Stelios is in the house. Always a pleasure. Rook getting beaten up? Sure. So this is why risk on assets are only a small portion of your portfolio. It went from I talked about it when it was $65, went to like 800, I think it was at. So, you guys need to have allegiance to your portfolio, not to a particular asset. I think Rook and Keeper DAO is an extraordinary project. Capturing MEV is extremely viable as a source of revenue in the coming years. I have my eyes on Rook. I have a position in Rook, and make sure you craft your portfolio balance such that when altcoins are down, the crypto macro assets, Bitcoin and Ethereum, will be up, because we know how retail behaves. If altcoins are down, they will sell the bottom, and they will buy the 5% rip to the upside for Bitcoin and Ethereum. So altcoins down, Bitcoin up. Bitcoin and Ethereum down, altcoins up. So I skew my portfolio such that I want minimum volatility, min vol, and I want a balance between my macro assets and my risk on positions. My goal is for the portfolio to remain constant. I want to tie my portfolio to the liquidity entering the crypto space. So you can have the volatility of the various assets, they should balance out. And then as liquidity pours into the crypto space, the portfolio rises in value with it. So my goal and my attempt and my thought process is to cancel out volatility by carefully choosing and structuring the portfolio with assets that carry very different properties, have very different time horizons. I have carefully chosen position sizes. I have various configurations in DAO and AMM platforms, and this is all very well thought out. uh, I got surgical with this shit. How about them apples? Captain Weber said, "Come on, you know it. You know I'm here. Smash them likes. 18 people in the stream, 11 likes. We can do better." Jesus in the house. DGB. When DGB? Ren DGB is already live. It's not on the bridge. But the problem is you need an incentive system, and that doesn't exist. RenDGB does nothing for the price of Digibyte. What you need is a place to collateralize it to. But you also need someone to want to borrow it. So borrowing is the driving force for monetary velocity. Without borrowing, interest, there's no interest to lend, so there's no need for RenDGB. So it's a bit of a chicken and the egg thing, but that's really the power of monetary velocity, and that's currently what's failing in the legacy financial system. It might not fail uh, into oblivion, and it'll probably recuperate, probably, but I don't want to take a bet like that. I bet on things that I have data for and I see that are heading in the outperforming direction. And the monetary velocity, anecdotally, I'm looking for very concrete data, but anecdotally is vertical in the DeFi space. Vertical. If you look at Aave, the crypto money market, the borrowing and lending is through the roof. If you look at MakerDAO, the collateralization is through the roof. If you look at the LPs, people are strategically positioned with hedges to mitigate volatility, capitalize on volatility, and mitigate risk. So there's very sophisticated players that are in this space. That is definitely not. It's not the case that they're absent. There's definitely smart money, really smart money in this space. Like Zero XB1 is that account I've talked about a couple of times. Those boys did it right. Now, bear in mind, we obviously have a large retail presence doesn't, which introduces maximum volatility. If an asset goes straight up, it's going to come straight down. They cannot handle 10% depreciative cycles, and they'll sell for whatever and turn it into the asset that's going up, Ethereum, Bitcoin, and this accounts for that effect. Altcoins down, macro assets up, and vice versa. Folks are always chasing the outperforming asset. Now, while this is the case for retail, that you have the irrationality that they're flipping in and out of assets, losing value all over the place, the smart money does this at the macro level. At the macro level, when the broad stock markets crash, that liquidated value needs to be expeditiously redeployed to markets that are outperforming. Why is this the case? If the NASDAQ crashes 30, 40, 50, 60%, all these dollars, trillions of dollars are going to be available. Dollars, they're losing value. They're losing value, one, to debasement, two, to asset price inflation. So you can't keep them in dollars. If you have $100 billion in dollars, you're losing millions of dollars a day in value to debasement. So they're going to have to redeploy that value as fastest ever in history to positions that are outperforming. Now, there's going to be incredible opportunities and positions in the equities markets. Incredible companies such as what I'm looking at right now, but there's a whole laundry list of battery metal miners and commodities. That plays into like the commodity super cycle narrative, because that shit's going to hit hard, boys and girls. So they're going to have to expeditiously redeploy that liquidated capital, fastest ever in history. They'll throw it in bonds for 5 seconds, and then because they're not locking it up in 30 years. The hell's locking up their damn money for 30 years? It's fucking crazy. Those 100-year bonds in Japan, insanity. So they're strong. They're strong yields. Was that 2%? But who's locking it up there? There's a reason why banks go for short end of the curve. Because it's short end of the curve. They go for the T-bills, the couple of month duration treasuries. But obviously you got the 2, 5, 10, so on and so forth, whatever the hell the intermediary durations are. But this looks extraordinary bullish. Got a fat bullish divergence here on the 2-year. So the short end of the curve looks actually bullish as well from a yield perspective, which means the bonds are selling, which means if this thing rips to the upside, you have confluence confirming the reflation narrative. Right now, the long end of the curve is up significantly. And that's the reflation narrative. But the short end of the curve, exemplified pretty decently by this graph, is distorted. I argue it's distorted because banks are buying the crap out of the bonds to front run stimulus. Because when stimulus occurs, the banks get enormous deposits, and for the banks to handle their books, they need treasuries. And so that accounts for the buying of treasuries, either by the Fed or by the banking institutions. And it's all too apparent. Now, when we see a story change, like if this breaks down, if the 30-year breaks down, that means we'll probably have a risk-off event where the broad equities market is collapsing, and the smart money is front-running the liquidation process, allocating value to bonds and cash. And that's cool. I'm not into bonds. That's just not my play. But bonds, if the yields crash, the value of bonds are going to skyrocket. So that's a play for many people. TLT, so on and so forth. Raul loves that play. Plenty of folks love that play. That's just not what I'm interested in. It's too short-sighted. I don't mind missing out on that value capture opportunity. I'm much more interested conceptually in where that money will go. It's not going to sit in bonds. Bonds are useless as a long-term value storage vehicle. And cash is actually destructive as a value storage vehicle. It bleeds value. So value, as I've said a couple of times, needs to be redeployed at a historically fast-paced to outperforming, inflating assets. Christopher says, can you tell inflated? How can you tell inflated from this chart? Okay, so inflated is relative. So this chart shows the best representation of comparing markets. So right now, Bitcoin, as of this morning, is outperforming every major market on the planet. The NASDAQ was the last remaining market that was waiting for a breakout. So here's the kicker, and this is why the high was here. This was a breach of the 2017 top. But I always tell you guys, you have to break resistance, retest, and print the new higher high. So what did we have here, boys and girls? Here was the resistance. Here was the break to the upside, the retest, and the higher high. So we now have bullish confluence, the most meaningful of bullish confluence, the trifecta of confluence on the last remaining market on the planet that Bitcoin had yet to outperform. So this means everything. Let me show you how you see inflation on this chart. So this is the weekly chart. So basically, this chart more or less says Bitcoin has zero inflation relative to Nasdaq. It hasn't even started appreciating yet. It is barely above its all-time high back in 2017. It has barely started appreciating. And what does that mean? If Nasdaq has yet to crumble and it is in its extraordinary inflated state, when it crumbles, value transfers from overinflated assets to underinflated assets. I mean, if you look at here, what is that, 2013? This is the RIP in 2013. So these are, you look at Plan B stuff and you can apply that. If you apply that methodology to a chart like this, Bitcoin is in a position to start significantly appreciating relative to one of the largest equity markets on the planet, NASDAQ. RIP outperform broad equities. RIP outperform broad equities. RIP, it hasn't even started outperforming broad equities. Bitcoin has just started. And now the whole thing that I talk about is if it just started, great. So you just want to own Bitcoin? Sure, owning Bitcoin is cool, but there's risk, there's volatility, there's upside downside potential, there's macro systemic events that could occur. And that's why we have hedges. And in the crypto space has emerged these DeFi protocols where we can manage our downside risk, muting our upside potential, all the while capitalizing the crap out of volatility. These LP positions are extraordinary. They behave like option straddles in many regards, but because how new the market is, it's not going to be like a one-to-one, a pure straddle. Both at in the money price. You're going to have instability across the AMMs, across the centralized exchanges as well. You're not going to have pure market homogeny. It's not going to be uniform. So you have, and that's exactly what is exploited by arbiters. The process of arbitrage is buying from one exchange, selling on another exchange, the same asset for a higher price to balance the system. So what I expect to happen is these LPs, especially when paired with the dollar stablecoin, are going to be extraordinarily useful in mitigating volatility in the coming years. You're going to mute your downside risk. You're going to mute your upside potential, but you're going to capitalize on extraordinary volatility, making an absolute fortune in the process. And that is that at some point the market will stabilize, and you'll have much less arbitrage opportunity, much less being exposed to upside potential. So, like Ethereum, DAI. If you're in a pool like that, I'd argue currently you still have good exposure to the asymmetric price appreciation of Ethereum. But when you have, let's say, a couple $1 trillion into the space in the coming years, you're going to have significantly less exposure to the asymmetric price appreciation of Ethereum because the market will be much more uniform. Interesting stuff. Let's look at the dollar real quick. Dollar looks extraordinarily bullish. Bounced off the 200 SMA, kind of, sort of, ripped through the 200 EMA, ripped through the 50 SMA, ripped through the 100 SMA. And what's fascinating is this is a trend reversal. Look at the 50 SMA crossing, bearish cross of the 100 SMA and the 200 EMA, and bam, it was looking to rip through the 200 SMA as well. But it ripped to the upside instead. So this is the definition of a trend reversal. What striking about this chart is how irrational it is. It's literally all over the frickin' place. It ripped out to the upside through a falling wedge. This is an extraordinary bullish break. We had a resistance flip support for a period of time, but it failed. It failed back in, bounced off a couple of moving averages, and ripped to the upside through trend resistance yet again. Now, Let's go on the daily. So this is probably where we're at. Um, Look, Stoke is completely oversold. This thing has barely just had a bullish signal cross. RSI is on the upswing. Bullish divergence. Well, it's not even a divergence. It's just bullish on the RSI, and it looks like it's going to push towards the 100 SMA on the daily at minimum. This is going to cause havoc in financial systems around the world. It's going to cause instability in the broad equities market, but that is what we're prepared for. We're not. Don't be exposed to the broad equities market. It is that's too much risk. I would have no interest in that. Plenty of smart Wall Street players will have, a Tesla stock and they have options to the downside. Maybe they sell covered calls and stuff like that. That's not my game. And there's a lot of people that do well with that type of strategy. But for me, I'm more of a value allocator. I like structure, I like organization. I really think of the portfolio as a piece of art that gets crafted to best express the way I view these markets and the way value is going to flow over time. And my goal, my interest, what excites me is allocating my value to markets that have yet to perform. They are uninflated markets that have yet to inflate relative to other markets. Value flows from overinflated markets to underinflated markets, following the principle of mean regression. Yeah, let's say you have a flat line and something is overinflated and something is underinflated. Mean regression both works both ways. Mean regression will pull the inflated market down and significantly push the uninflated market up. That's the way that works. Um, Long end of the curve was this the 30 years, so it's pulling back. We can have easily a systemic event where we have risk off and the 30-year yields and the short end of the curve, the yields fall off a cliff, and we have the risk off event. But that falls right into the commodity supercycle narrative, where the broad equity space liquidates, and then the outperforming asset class becomes value versus growth. Now. And it also plays into my narrative of the great value reallocation. I think my narrative is consistent with the commodity supercycle, but obviously the commodity supercycle does not consider the crypto space. So commodities, mining, metals, and crypto are going to be the assets that outperform over the next decade. That's usually about my time horizon. After that, it gets a little foggy, considering technological change and innovation and whatnot. But it's the only way to say it is it's more likely than less that this is the way it's going to play out. It's how could you apply value to a fragile paper tower of the broad equity space and say that's a good idea? That it's just going to keep going up? That it's a new narrative? This time it's different. It just go. No, there's no logic to that, guys. There's absolutely no logic to that. These assets are overinflated, and there's no, and the we talked about the participants and the psychology at play across the breadth of participation in those particular assets. They're not capable of handling a depreciative cycle. It's going to collapse. It's just a matter of time, which means, sure, there's probably lots of people that play those assets strongly, probably even leverage to the upside. That's just absolutely of no interest to me. I think crypto is just extraordinary with the LP positions available. Oppian has some options available. There's inverse synthetics on synthetics. There's a leverage position, DYDX, and just you could do so many things that make it easy to to treat the broad equity space as non-existent. Why even look at it if you could do things in the crypto space that you can obviously do in the legacy financial system, but you have more power, more tools, more freedom, more less dependency on infrastructure. This is all autonomous smart contract functionality. So you're not tied to companies and government and all that stuff that we know all too well. So biggest opportunity of a lifetime, in my opinion. Going back to this chart one more time, Bitcoin hasn't even started breaking out. So bear in mind, that doesn't mean there's lack of volatility. And as trillions enter the space, that volatility will decrease. But we're right about here. Let me zoom in. Let me show you guys. Let me show you guys. Show you guys the secret sauce. So just because there's the Bitcoin is yet to inflate as compared to the broad equity space, doesn't mean you can't have volatility. So let's say you're right about here, we can have a fat retest, fat 15 to 20% correction on Bitcoin. All right, so are you 200% annualized appreciation on a yearly basis for the last 10 years? Do you really care? Come on, guys. Do you really care? Just accumulate the Bitcoin. Don't even think about the dollar valuation. Basically, focus on the fact that you have zero point 0.1 today, zero point 0.2 tomorrow, zero point 0.3, so on and so forth. You have more. That means you're saving value. It's just denominated not in dollars. The biggest fallacy and the biggest mistake people in the crypto space, and frankly just completely ignorant of in the legacy financial system, is valuing things in terms of dollars. That's such a old mentality and methodology. Uh, the only reason people do it is because everyone does it. And that's probably the best reason to stop doing it, because the people that do best in society are the people that think different, the people that don't follow norms. They stand out. They see through what people accept as the status quo to identify, once in a lifetime opportunities. Here's an interesting statement that I mentioned on Twitter earlier. What is playing out right now in the DeFi space? It has not happened. This is new this time. The monetary velocity is disruptive of the legacy financial system and will draw in value, because that's what monetary velocity does. It draws in values in search of opportunity. So what is being created by the likes of Curve, Aave, 1inch, Uniswap, probably Banker and Kyber as well. They're there. They're there. They have some serious tech. So when this market inflates, they're going to inflate along with it. But you're seeing the foundation of new industry titans. I think 1999, Gates, Jobs, Bezos in whatever, a garage or a tiny office just starting out their mega corporations. That's what's happening right now. And what happened over the last year between May of last year, May 2020, and now is I don't even have words for it. It's empirical evidence that what's occurring is actually playing out, because the monetary velocity has emerged. And we know, based on the legacy financial system, that monetary velocities sustain financial systems. And when the monetary velocity starts to falter, you have to have central bank intervention, and they have to try and stimulate the economy. But as of right now, the monetary velocity in the crypto space is basically vertical, fueled by ridiculously novel and innovative game theory platforms that have strategically crafted inflationary and deflationary characteristics to the protocol, incentives, and yield bearing opportunities, and lending and borrowing functionality. I mean, that's some crazy shit, guys. A whole nother level. Let me get some comments, and we're going to wrap this up. 12:01. Any new experience regarding late BlockNet updates? Yeah, BlockNet's off the hook. Love BlockNet. I've been running a service node for the better part of like 4 years at this point. What'll happen will happen. Excuse me. Um, I, excuse me, guys. I don't have any particular updates. I mean, the Xlite wallet is ridiculous. The service node functionality is ridiculous. The DEX is ridiculous. Everything about the project is ridiculous. The only thing that's lacking is social media network effect. What it catches or it doesn't catches. I don't. It's indifferent. I am indifferent. My allegiance at this point is to, frankly, a little bit contrarian to the way I handle my portfolio is to the project. My position in BlockNet is irrespectful of my portfolio, actually. I intend to hold that service node in perpetuity. I exclude it from how I assess the balance of my portfolio. That's just the way I'm handling things. Duncan, DGB testing the 200 on BTC daily chart as we speak. It flips, we're in business. I'll give you a DGB update. Everyone knows my fundamental analysis of Digibyte, so let's take a look at what's more important with regard to value allocation. You can't invest in assets based on fundamentals. Fundamentals tell you where to look, technicals tell you when. Digibyte is currently uninvestable. Digibyte needs to break above the 200 SMA on the weekly for it to have significant bullish confluence. You want to see this. Break to the upside, retest, and the higher high. So interestingly enough, we wait for price appreciation before taking a position. If I would take a significant position in Digibyte, I would wait for an 86% rip to the upside. In dollar denominated terms, that'll probably put it at 14 to 18 cents, which will beat the pants off the 2017 dollar all-time high. And that is a great example of how inflated the crypto space is relative to 2017, how much more capital is in the space, and frankly, the Bitcoin valuation, which is probably the best way to value assets in the crypto space. Dollar denominated doesn't mean much because um, we're not trading against dollars. We're trading against the asset that is outperforming the most. And the asset, really the base reference, is Bitcoin. That just makes logical sense to myself. So Digibyte has done some significant appreciation, smacked into the 200 EMA in the weekly, and got completely rejected down at 159. It was at 159 in October, so it's made no gains for all of 2021. Frankly, it's made no gains since April. It's made no gains since April 2019. So, this is the way you got to look at it. I love my Digibyte. Fundamentals tell you where to look. Technicals tell you when, because your allegiance is to your portfolio and not to a particular asset. You love an asset, and you don't want to lose 100 grand loving an asset. I'm just being honest, boys and girls. Do you have any knowledge of the hiding game with Rook, where traders extract MEV? Sure. Use the hiding game, guys. It's right here. Use it. No reason not to use it. It's a limit order. So you go to app.keepitnow.com/trade. It's only a limit order. Throw something on there. Throw one and a die. It's a limit order system, so it's not market price. Market price is barely click through. So if you do, 550, so you got to offload your stuff, and then when you do a trade, you're gonna get rewards denominated in Rook, and you'll see that on the pooling page. So don't forget that you have to underbid your transaction for the transaction to execute. And guess what? The best part? Zero gas. So what those $200 Ethereum transaction fees, if you do your trades on the hiding game, on this page, zero gas. And frankly, if you go over to 1inch or Maca exchange, you're going to also pay zero gas for your transactions. So folks on Twitter, screaming about gas fees, don't understand what can be done with the system. And frankly, guess what? The big whales, throwing around $100,000 transactions, they don't care about $200 transaction fees. So the reason why we're at 150 GUI at all times is because, listen, I'm throwing around $200 transaction fees. Boom, boom. I must have done like $3,000 worth of transactions yesterday. Just gas. It's just, that's what it is. If you want to capitalize on these markets, you spend value to rebalance the portfolio to better extract value from the platform, capitalizing on volatility and balancing upside potential, minimizing downside risk, and strategic portfolio reallocations. White Wolf, you're very welcome. That's the name of the game. Keep it down. This is some serious tech. I mean, between EIP 1559 and MEV extraction, wow. Wow. I mean, keep it down. This is some of the coolest tech I could think of in the entire crypto space right now. Now, I used to have a much larger position. I'll share with you guys the deal. Much less. It was at 36, 37, much less. I get a lot of rewards because I use the trading platform a lot, much less of a position. This thing went from $65 to like $800. Sell on the way up, sell on the way down. Don't hold allegiance to a particular asset. Respect your portfolio, but love assets. I absolutely adore this platform, this project with these boys on the Ren team have created. It's fighting fire with fire. There's a huge amount of value extracted from analyzing the mempool by people seeking arbitrage opportunities. And that cost us doing market trades a lot of money. So this technology that these boys are pursuing is downright awesome. That's so cool. But it doesn't mean I'm going to risk value over allocating to a position. That would be counterintuitive and disrespectful to my portfolio. It would mean I'm not honoring my fiduciary responsibility to myself. So, separate and apart. Price action, portfolio allocation has nothing to do with how you feel about a platform. This thing is ridiculous. Absolutely ridiculous. Name of the game, boys and girls, 12:08 p.m. for Wednesday, February 17th. 25 people in the stream, 21 likes. Typically, I would say we can do better, but damn, not bad, boys and girls. As always, thank you all for joining. I will see you tomorrow. I wish you all a wonderful day now. Peace.